I downloaded that optimal capital structure template and I'm having trouble with it. Can I show it to you really briefly after class?
Okay, folks, let's get started. Yesterday I sent out a puzzle, which I know you probably haven't even looked at, about Walgreens. Everybody's familiar with Walgreens, right? Basically pharmacy, consumer products, and in fact I think last year they bought Alliance Boots, which is a Swiss company, with Boots being the UK based, So it's a company that I picked because it's been targeted by activist investors as a company that should be doing a recapitalization. Remember we talked about recapitalization? You borrow money to buy back stock. So we talked about why that might create value. We used the Disney example of recapitalization creating value. And remind me again where the value is coming from. It's coming from tax benefits, $19 billion in value. So Walgreens was targeted. It caught my eye because I saw the news story and I said, okay, and I do this anytime I see a company targeted by an activist investor, because this is a joint test of both whether the company is underlevered and whether the activist investor who's targeting the company has any sense. Don't assume just because you are an activist, you see an activist investor, and that activist investor has made a lot of money, that they know what they're doing. So trust but verify. So I said, okay, let me take a look at Walgreens, because what do you need for a recapitalization to create value? You've got to be underlevered to begin with, right? So if you have too little debt, then the rationale makes sense. If you don't, then it doesn't. So Walgreens is fighting the LBO, the leverage recap. It's not quite LBO, saying it doesn't make sense for us. The activist investor is saying, no, you can borrow more money. And the equity research analysts are split because they have no idea what's going on. So I took Walgreens and I sent you the income statement, the balance sheet numbers. So what I'm going to do is I'm going to take the spreadsheet that I sent all of you and go through the numbers, partly to see what Walgreens optimal is, and partly to get you ready for when you have to enter the numbers for your company. So this is the only page, actually, almost every number you need for the optimal is on this page. Everything else don't mess with. It's being done in the background. Just let it go. Okay? So let me start at the top and work down. So if you've seen the spreadsheet, it should look pretty familiar. So I start off by asking you what the name of the company is. If you have trouble at that input, and you probably have troubles that I can't solve with the capital structure spreadsheet. So hopefully you have a name to put in. And it asks you for a date, just as a reminder. And I do this for myself because I've got capital structure spreadsheets spread out across time to know when I did this. Okay? Then it asks you for some very basic numbers. And none of these numbers should be tough to find. First, it asks you what the EBITDA for your company is. Earnings before interest, taxes, depreciation, and amortization. Income statement, the number for Walgreens was $5.357 billion for the last 12 months. You see, what are the last 12 months for strange months? We'll come back and ask that question. We can look at the history to see if it was a bad year or a good year, but I use that as my starting number. Right below that, it asks for depreciation and amortization. You might not see this on the income statement because it might be consolidated into your cost of goods sold. But you know where you'll always find it? Which statement? Go to the statement of cash flow. Second line item should be capped. No. So I pull the depreciation and amortization. Stay on that statement of cash flows. And somewhere in there should be a capital expenditure line item. Because it's a statement of cash flows, there'll be a minus in front of it. I know your capital expenditures are a minus, so you can skip the minus and just enter the absolute value. So don't enter a minus number, because then the spreadsheet will take a minus of a minus, and God only knows what's going to happen to the whole thing. It'll blow up on you. So just enter the absolute value. Then I ask you for the interest expense on the debt. You go back to the income statement, then there should be interest expense on the debt. Then I ask you, what marginal tax rate do you want me to use to come up with the optimal? Remember we talked about this. You're saying, if it's a multinational, which marginal tax rate do you use? And we talked about going with what makes the most sense for you as a company. And if you're Walgreens, even though you've acquired the Swiss UK Alliance Boots, the reality is you're going to try to keep your interest expenses where it gets you the most oomph. which is the US. So I went with a 38% marginal tax rate for the US. If you're working with the US, it's going to be somewhere between 35 and 40. It's not going to be 26. It's not going to be 51. So it's somewhere between 35 and 40. 35 is your federal plus state and local taxes. Walgreens is rated right now. Moody's rating is Baa2. S&P's rating is BBB. Already you can see that the activist investors who are pushing are on pretty fragile ground, right? Because you're already at investment grade, you're at the tipping point. So file that away because that's one strike against the activist investors, but right now their rating is Baa2. And in fact, it's a pull-down menu. So basically you don't have to enter it. If you go in and you look at it, it lets you pick what the rating is. And it gives you the S&P, Moody's. Pick one. If they're different, pick one and stick with it. It doesn't matter. The default spread for a BBB rated company right now in the market is 1.75%. You're saying, why don't you just look up a Walgreens bond? God only knows what an individual bond's yield to maturity is going to be, because strange things can happen. So I took the default spread based on the rating. That gives me, and I used a 2% T-bond rate, just, it's probably 1.9 something. So I've just rounded it up to 2%. Risk-free rate is 2% plus 1.75% gives me a cost of debt pre-tax of 3.75%. If you don't have a rating, don't worry, there's an NR in there. Just put not rated, and then I'll use your synthetic rating from the spreadsheet as your starting rate. Then I ask you how many shares are outstanding in the market price. I usually just go online, look up whatever the price is today and the number of shares. Why go through a 10K or an annual report when you have updated numbers? And right now the price is about $92, and there are 1,092.8 million shares. So roughly speaking, the market cap for the company is about $93 billion. Then I ask you for the beta for the stock. And this is the one thing which, if you haven't done anything on your project yet, the only beta you're going to have is a regression beta. If you've done the bottom-up beta for your company, breaking it down to businesses, I'd rather you use that. And for Walgreens, that's what I used. I used the bottom-up beta, and it's in one business. It's really retail special lines. The unlevered beta is 0.87. I basically then came up with a beta of about 1.0577 based on its existing debt-to-equity ratio. So bottom-up beta is better than a top-down, but a top-down, if that's all you have, at least for purposes of doing the optimal, enter that beta. Then I ask you how much you have in cash and marketable securities. I went back to the balance sheet. I counted cash and marketable securities as well as short-term investments because companies increasingly are keeping it. So collectively that amount is $3.082 billion. So far, any questions? So almost everything we've looked at should be easy to get. It should be right there, either in the financials or in the marketplace. Then I try to get really helpful. I ask you for the book value of your debt. So what are you going to count here? All interest-bearing debt. You're saying, what about leases? I'll take care of it. Don't worry. For the moment, just go to the balance sheet, count long-term debt, short-term debt. So basically, any interest-bearing debt. And for Walgreens right now, that's about $16.9 billion. And here's where my helpful side comes out. I say, can you estimate the market value of the interest-bearing debt? Just say no. Act completely lost, as I have no idea. Then I say, do you want me to estimate the market value of the debt? I say, yes, yeah. Then I ask you for the maturity of the debt, which you should be able to get because the breakdown of the debt is right there. If you go to Walgreens footnotes, it's about 7.5 years. A lot of long-term debt, so it's about 7.5 years. And then I ask you, do you have any operating leases? Just say yes if there are leases. And if there are yes, see that operating lease worksheet? Make sure you go in and update the numbers. Otherwise, you'll be locking in whatever leases were in the previous companies. These are the operating lease commitments for Walgreens. It's actually Walgreens Boots because one of the tricky things was the acquisition of Boots happened over the course of the last year. For some of you, this is going to be an issue. So I had to go to the latest 10Q, and I got lucky. The latest 10Q, which is a Walgreens Boots 10Q, it's a consolidated 10Q. They do give the combined lease commitments, and it's huge. And that should come as no surprise. If you've gone through London, you see Boots stores all over the place, and same thing with Walgreens. It's almost $3 billion in commitments for next year, kind of going out over time. That's pretty much all the inputs you need. Let me go back to the input page because there's some macro inputs I'm now going to ask you about. I ask you, do you want me to incorporate indirect bankruptcy costs? Remember we talked about this indirect bankruptcy costs. If you say yes, I'm going to adjust your operating income as your rating drops off. Shall we make it yes for Walgreens? I think so, right? It's a retail store there. Let's make it yes and leave it at leave it at medium. I don't think it's high. I don't think it's low. It's somewhere in the middle. So then I ask you, what's your risk-free rate? And depending on the currency you're working with, the answer can be different, right? So if you've been working with euros, this might be 0.2%. If you're working with US dollars, it might be 2%. With rupees, it might be 6%. Stay consistent. So I was here because I'm doing everything in US dollars. I entered the T-bond rate as my risk-free rate. The equity risk premium is supposed to be what? Reflect where you get your revenues. I was looking through the 10Q and I was doing it in a hurry, so I might have missed it. They claim to be in 19 countries, but didn't tell me how much they make in each country. This is a remarkably unhelpful way of telling me that you have revenues in a lot of places. The bulk of their revenues are still, I think, US, UK. They have a pretty big Mexico component. Okay? I took a weighted average best I could of whatever I can. And this is something some of you are running into with your company. The breakdown of revenues is not as detailed as you'd like it to be. But you have to live in the world you're in, not the world you wished you were in, and this is all I have. And I don't think it's going to make a huge difference anyway, so I put it at about a 6%. Higher than the 5.75% I'm using for the US because there is some emerging market exposure. You say, what's that country default spread? You know what that is? If you're doing an Indian company, remember we said that you're going to add the country default spread for India to your synthetic cost of debt? So if you're working with an emerging market company, enter the default spread for the country. This has nothing to do with your company N. And what I will then do is add that default spread on to your cost of debt, saying you've got to bear both burdens. The final three questions seem like trivial questions, but they cut to the heart of what I tried to do here. First is, I ask you what spread table, because I have two lookup tables, one for large market cap and one for small market cap companies. This is a large market cap company, so I went with one, but if this were a small market cap company or an emerging market company, I would go with two, because then I'll put you through a tougher test. Then I said, do you want to assume that the existing debt is refinanced at the rate? You see, what the heck are you talking about? I didn't really talk about this when I did the Disney analysis, but as I went from 10 to 20 to 30 to 40 to 50% debt, the rating changed, right? As the rating changed, the interest rate that Disney would have to pay changed. I was implicitly assuming, and I should have been explicit about this, that when your rating changes, you have to refinance all of your existing debt at that new higher interest rate. Why? To be fair. You see why? Because if you borrowed money when you had very little debt, you were able to get a low interest rate. Now you move to a much higher debt ratio. You're saying, well, I don't want to be fair. I want to rip those guys off. This is my, do you want to rip off your bondholders question? Okay? If you say no to that, I will rip your bondholders off. So be your own, make your own decision, but sometimes it's out of your hands, because if there are covenants, there are protections in the existing debt, those guys are going to come back and try to extract the higher interest rate from you. The safest thing to do is leave that at yes, because your debt will get refinanced then at whatever the new rate is. And then I ask you whether you want your current rating, because you gave me an actual rating, whether you want me to replace it with a synthetic rating. And we'll talk about why you might want to do that for some companies. But the safe answer for that usually is no. Because if you have an actual rating, might as well use that. That's it. You want to see what the optimal debt ratio is? Remember again, it's been targeted because, in fact, the summary is right here up at top. So but I can go to the actual full. Let me go to the optimal. That's what the output looks like. Remember I told you that I will fill in the blanks on all the sections you haven't done? If you look under the current, that is your existing cost of capital, with leases capitalized, with everything that we've talked about so far. And right now, this is what Walgreens looks like. It looks like it has 30.5% debt, 69.5% equity, and its cost of capital is roughly 6.51%. Based on its cash flow generating capacity, its optimal debt ratio is 30%. Looks like it's pretty much where it should be. So on this fight, at least, I'm on Walgreens' side, because I think they have a good case saying, hey, what you want us to borrow another $5 billion? It's going to tip us over the edge. We're going to get over levered. You're saying, but the recapitalization by itself is not what's creating value. Recapitalization creates value only if you're underlevered moving towards your optimal. Buying back stock by itself doesn't push up your stock price. It's because you're buying back stock with debt that is creating the tax benefit that's pushing up your stock price. This is not a magic bullet where any company can recapitalize and increase its value. It depends on where you're starting from. And at least in the case of Walgreens, it doesn't look like there is any basis for the view that they have excess debt capacity. So any questions on the setup? Okay. So yes, go ahead.
On the bankruptcy costs, are they probability adjusted?
We'll go through, basically it is expected, it's a probability, there's no probability component here, right? Because in a cost of capital approach, there is no way to bring in a probability. It's basically your operating income decreases as your rating drops. It's a rating triggered change in your operating income. Okay? So once you go to that rating, your operating income is guaranteed to drop in the spreadsheet. It'll knock the operating income down. Right? So the optimal debt ratio I have is 30%. So today we're going to start off by talking about what is it that makes the optimal for Walmart 30 and for some other company 70 and another company 0. Let's start with the obvious one. We already know that the driver of value from adding debt is what? The tax benefit, right? So let's try changing the tax rate. So you keep your eye on the right on the output summary. I'm going to take everything else and leave as is and change the tax rate from 38% down to 0%. There it is. There's your optimal debt capacity gone in a second. I move Walgreens to the Middle East and I take away their interest tax saving. So the next time somebody talks about companies borrowing too much money, there's the reason why they borrow money. It's driven by the fact that you get a tax benefit. So let me set that back at 38%. Okay. What if I were a populist and said corporations are not paying enough tax, let me make the tax rate 60%. Let's try that. No? Let's go French. 60% tax rate. In this case, it actually does very little to my optimal because it basically I start running out of income at some point in time. So pushing up the tax rate is not leading me to borrow more money once I get past a tipping point. But if I lower the tax rate to 0, my tax benefit goes away and my capacity to borrow money goes away. So that's the first thing I want to ask the third. Second, if you remember the way I described this approach to coming up with the optimal, I said it's an income-driven approach. I don't care what's in your assets, I don't care what your book value is. It's an income-driven approach. Let me emphasize that. The key number in this capital structure spreadsheet that drives your optimal outside of the tax rate is how much you have as cash flows to service interest expense. So which item is going to capture your capacity to service interest expenses? Go over to the EBITDA. Right? Let's suppose that as Walgreens and a retailer, you're concerned about a drop in operating income, recession. Let's say I drop the operating income down to, what should we do it? Drop it by about 20%? Walgreens is actually a pretty stable company in terms of the income because they get so much of the revenues from pharmacy revenues and those tend to be pretty stable. So let's make this 4,500 and see what happens. That's still 30%. How about 3,500? Still 30%. This is a very, very tough firm to make go away. Okay. I've got to drop the income. So the 30%, they're actually in a pretty solid spot. But if you start going to 40 or 50%, you very quickly hit tipping points. So when you sit down to do your optimal, initially do it with the last 12 months of data. Then you're free to ask what if questions. What if I use average income over 5 years? What if I take a bad year's income? What if my tax rate changes? Because those are all things that might affect your optimal. But it's best to have a base case before you start to ask those what if questions. Any questions? Yeah.
What happens if you remove the bankruptcy costs?
Okay.
Actually, the enterprise value was increasing when I include the bankruptcy.
It can, in this case, I don't think it makes much of a difference. But in some cases, In this case, actually, now when I lowered the income and changed the bankruptcy cost, it made a difference. But when I left the income where it was and lowered the bankruptcy cost, it didn't. Because remember, what triggers the bankruptcy cost is your rating dropping below triple B. So if that's happening at 50 or 40% debt for you, then the bankruptcy cost trigger will affect your optimal. So for some of your companies, it'll make no difference. For some, it'll actually lower the optimal debt ratio. Any other questions? Okay, so when you get a chance, try this. As you saw, it took all of, 11, 12 minutes to enter the numbers. Okay? And if you have your financial statements, none of those numbers should be difficult to get. One more thing, I forgot to pull this up here, but if you, in Excel, there's a preference component where you can go in and set preferences. Some of you, when you open the spreadsheet, will get a warning that there are circular references. Remember what I said, don't try to fix it. It's a feature, not a bug. And what you have to do is go into the calculation preferences and make sure there's a check mark in the iteration box so that it's able to do that circular reasoning, because that's the only way I can come up with the optimal at every debt ratio. Okay. So let's go to page, I think we were on page, 77? Somewhere around there. Yeah. So we're talking about the optimal financing mix for a financial service firm. And I said, with a financial service firm, stop even thinking about debt. Think about regulatory equity, book equity, because that's what's going to drive your optimal. And try to think about what makes the most sense for a bank, an investment bank, an insurance company. So the first thing I want to talk about today is something I've already touched on. When you look across your group, there are 6 people in the group, and you see different optimal debt ratios. I want you to think about why they're different. And if they're similar, I want you to think about why they're similar. First thing you should focus on is tax rates. You're saying, how can they be different? You could have an Irish company in your group and a US company. Maybe that explains why Ryanair has a lower optimal than Delta. So look at the tax rate. In this case, here's what I've done. I looked at what the optimal debt ratios would be for the companies in my sampling as the tax rate goes from 50% down to 0%. And at 0% across the board, I get a 0 optimal debt ratio. In fact, if you get a debt ratio greater than 0% at a 0% tax rate, something is wrong with your spreadsheet. Okay? Second, as you look across your companies, you are going to find that some of your companies have high optimals and some have very low optimals. And I'll give away the secret, even if the tax rate is the same, as to why some companies have high optimal debt ratios and others have low. And it goes back to what I mentioned in the context of Baidu. I said Baidu is a money-making company. It makes a lot of money, but relative to its market value, it doesn't make that much. So here's what I'd like you to do. Take the EBITDA that you had. Remember the EBITDA that you inputted on cell 4 or B4 or whatever that was? And divide it by the enterprise value of your company, market value of equity plus debt minus cash, which is actually computed in the spreadsheet. So you'll see the EBITDA, you'll see the enterprise value. You're saying, what do we do next? Divide the EBITDA by the enterprise value. You're going to get a percentage. For instance, with my companies, here's what the percentage looks like. 9.35, 17.95, 17.52, etc. Holding all else constant, the higher that number, the higher your optimal debt ratio is going to be. Think of why. When I have a lot of EBITDA coming from my company, I have a lot of cash flows available to service debt. I know some of that has to go back into CapEx, so that's why I've also computed the EBIT as a percentage of enterprise value. But that's the driving force into why some companies can end up with really high optimal debt ratios, because the cash flows are high relative to what the enterprise value is. So if you see very high optimal debt ratios, this is usually the culprit. You're a company with a lot of cash flows relative to in fact, I took EBITDA and divided by enterprise value, right? If I invert that ratio, I get EV to EBITDA, which is actually a very widely used rule of thumb by LBO guys. They'll say, I'll do a leverage buy if your EV to EBITDA is less than 6. What they're focusing on is this ratio, basically saying, well, I can service a lot of debt. The danger, of course, is this is last year's EBITDA. It could be gone tomorrow. So you've got to be careful about that EBITDA being sustainable. But that's the second factor that drives the optimal. Which means if you're a high growth company, you do this for a Google or a Facebook, you will end up with a relatively low optimal. Not because they don't make money, but they make little money relative to their market value. That percentage is a low number. Third, risk matters, obviously. Riskier companies, holding all else constant, will have lower optimal debt ratios than safer companies. And it shows up in the spreadsheet in two places. One is it shows up through the unlevered beta, the bottom of the beta of the businesses you're in. So the higher that number, the higher the cost of equity becomes. The second is it shows up through the default spreads and the cost of debt, which I only capture imperfectly because I have only large companies and small companies. But you can think about the real marketplace. There could be 10 deciles based upon risk. And if you're a really risky company, your rating might always be lower than an otherwise similar, safer company. So those two factors kick in, and it shows up through the levered beta and the bond rating attached to your company at different debt ratios. So tax rates matter. How much you generate in cash flows matter. How risky you are as a company matters. There's only one macro variable that matters, and it's not the one that you think. I've heard people tell, people tell this to me, claim this at least on the face of it all the time. They say interest rates are low, so finish the story in terms of optimal debt ratios. Therefore, companies should borrow a lot of money and have high debt ratios. What's the flaw in that logic? Part of the statement is true, right? If interest rates are low, the cost of debt will be low because it's... But if interest rates are low, what am I comparing the cost of debt to? The cost of equity. What goes in the cost of equity? The same low interest rate feeds into my cost of equity and brings down my cost of equity. There is nothing ex ante that I can tell you about optimal debt ratios based just on interest rates. If you say, if interest rates go down, will my optimal go up? I have no idea. But I can make a statement about debt versus equity. It's not the interest rate that matters. It's what I add on top of it, right? So in the equity market, what do I add on top of the risk-free rate to get to a cost of equity? A beta times an equity risk premium, right? So when the equity risk premium is high, my cost of equity is going to be high. And in the debt market, I take a risk-free rate and add a default spread to it. So I'm going to show you a graph that is revealing in terms of how it affects companies' financing choices. And in this graph, the blue line is actually the implied equity risk premium. Remember the way I computed it based on where the market's at, so it goes up and down. So when that number is high, I'm adding a big spread on top of my risk-free rate. When that number is low, I'm adding a small spread. This black line is actually the default spread on one ratings class, a BBB rated bond or a BAA rated bond through time. So think of that as a measure of how much the bond market is charging for risk. Most of the time, the two move together. When one goes up, the other goes up, right? But there have been at least a couple of periods in the last 20 years when the two have moved in different directions. And when that happens, your financing choices will be affected as well. So let's take the first one. In the 1990s, if you take a look at the equity risk premium, what's happening to it? Dropping down, 96, 90, and so it's dropping down to about 2%. Remember we talked about the implied equity risk premium end of 99? Default spreads, on the other hand, were actually creeping up during the same period. So put yourself in the shoes of a CFO thinking about raising money for your company in 1999. So you're the CFO, you're saying, should I use debt or equity? What's the equity market doing? It's charging almost nothing for risk, right? So you can raise equity at almost no risk premium, or you can borrow money, and this is a BAA rated bond, which is a pretty safe bond, at roughly the same spread that you would get for issuing equity. So what would you do? Issue equity or debt? You're going to issue a lot of equity. You're going to issue equity like it's going out of style because the equity market is charging nothing for risk. That's, of course, that dot-com boom, technology boom, companies issuing equity. Then, of course, the boom bust, as booms always do. And then you get to 2001, and of course you had 9/11, and Alan Greenspan, with the hubris of all central bankers, said, I will not let the US economy go into recession. And the way he tried to accomplish that was by essentially pumping up the bond market. Pumping up the bond market in what sense? Take a look at what happened to default spreads, starting in 2002, going through 2007. Right? Equity risk premiums also drop, but not by very much. So if it's 2006 and you're a CFO, here's what you see. The equity market is charging 4.5% as an equity risk premium. Not high, not low, but somewhere in the middle of historical norms. Default spreads in the bond market have dropped to close to nothing. So what did you do? You're going to borrow money like it's going out of style. In fact, this is the golden age of an LBO, right? Because what do? You borrow money from the bond market that's charging you nothing for taking risk, and you take that money and buy equities which are being priced with a 4 or 4.5% risk premium. It's like holding a golden platter in front of you and say, take it. So what you should think about is the relative measures. How much is the equity risk premium versus the default spread? And right now the equity risk premium is about 5.75%. The BAA default spread is about 2.5%. By historical standards, the equity risk premium is a little too high. Historically in the US, the equity risk premium has been about twice the BAA default spread. It's now about 2.25, which means that you are going to see more debt issues than you should. You're encouraging people to borrow money, not just with the tax code, but because of the way the markets are tilted. And that's not good, because when you get the adjustment back, you're going to find that the reason you borrowed was nothing to do with your company, because you were. So think about that. That's your only macro variable that matters, and by altering those macro variables, you can create some unpleasant consequences. So when you get a chance, enter the numbers into the spreadsheet. The project is not about can you compute the optimum, because you're not even doing it. I'm doing it for you. It's whether you can read the optimal. I'm going to assume that there are going to be lots of tools out there. Anybody can compute an optimal. But can you read the optimal? So what I'm looking for is, can you look at the optimal and tell me why your company has the optimal that it does? What is it about your company that gives it a 10% optimal or an 80% optimal? So look at the risk, look at the tax rate, look at the cash flows. Dig past the numbers. Don't tell me my spreadsheet gave you the optimal. My spreadsheet just takes your numbers and gives you the optimal. So it's somewhere in your inputs that the optimal is what it is. Look to see which number is driving that. Okay. Any questions about the cost of capital approach? Because I'm going to put it to sleep and move on to the second way of coming up with the optimal debt ratio for a company. It's called the adjusted present value approach. It was invented in Chicago, the University of Chicago's business school, probably about 30 years ago. And in fact, in many business schools, it's taught as the only way to compute the optimal. And there are many investment bankers who think of this as the only way to compute the optimal. So I'm going to approach it from the perspective of, let's give it a shot. Let's see what this approach is, and let's see how it approaches coming up with the optimal. Remember how we came up with the optimal in the cost of capital approach? We tried to see what would happen to the cost of capital as your debt ratio changes. The adjusted present value approach doesn't do that. Here's what it starts with. It starts off by asking the question, what would the value of your company be if you're an all-equity funded company? It's called an unlevered firm value. We'll talk about how to estimate that. That's the starting point. Then it looks at how much you borrow, and it asks two questions. What is the primary benefit of debt, which is what? The tax benefit. It adds a tax benefit. And then it says, what's the biggest problem with borrowing? And there's an expected bankruptcy cost. It subtracts out the expected bankruptcy cost. So at every debt ratio, here's what it does. It computes the value of the firm as the unlevered firm value plus the tax benefits of debt. So rather than adjust the cost of capital for it, it actually computes a dollar value of tax benefits and an expected bankruptcy cost. So from that perspective, it looks like it makes sense. Now let's look at the practicalities of how exactly we do this. And you're already going to see why most people who claim to use the APV approach are really using 2/3 of the approach. Getting the unlevered firm value is not difficult. I can do it by either doing a full-fledged valuation of the company using the cost of capital they would have had if they'd been all equity funded. How do I get that? If you're all equity funded, what's your cost of capital going to be? It's going to be your cost of equity. And that cost of equity is going to be computed using your unlevered beta. So basically, you could do that. So there's actually a shortcut I can use too. I can take the value of the firm today, which incorporates whatever you borrowed. And if I can take out the effect of the existing debt, I can come up with an unlevered firm value. So step one, I can get. Step two is the tax benefits from debt, right? So when you borrow $1 billion, the tax benefit you get is on the interest expenses on the debt. Every year for as long as you hold the debt. In fact, there's a shortcut that you can use to compute what the present value of the tax benefit is, which is if you take your debt, which could be $1 billion, and multiply by a tax rate, roughly speaking, the present value of your interest tax benefits in perpetuity is roughly that. So if you borrow $1 billion and your tax rate is 40%, you just added $400 million in value to your company. So step 2 is trivial. Just multiply the tax rate by the dollar debt. So far we're moving along, right? Then I get to the expected bankruptcy cost, and there are 2 numbers I need. First is I need a probability that you will go bankrupt. Second, I need you to tell me what the cost of bankruptcy is. What cost? I'm talking both about the direct and the indirect cost. What percentage of the value of the firm will you lose in the event of bankruptcy? And it's on that number that people break down. There are actually studies that show that it can be anywhere from 15 to 40%, but that's about it. So here's what most people who use the APV approach do. They do step 1. They do step 2. Then they get to step 3 and they start waving their hands saying, too difficult, too complicated. Let's just ignore it. Let's see, if you take the unlevered firm value and you add the tax benefits of debt and you ignore the expected bankruptcy cost, what's going to happen to the value of your firm as you borrow more money? It'll always go up. This might be the cynical explanation for LBOs. Maybe these guys just forgot about the expected bankruptcy costs. Or worse still, they're hoping somebody else will bear the expected bankruptcy costs for them. But never attribute to malevolence what you can attribute to stupidity. Okay? I think it's just because they've forgotten it. Yeah. To get the probability, right? In fact, I'm going to suggest you can do it. If you want to use the APV, let's do it right, is my point. And there are ways to do it right. You might not be comfortable at the end still. But I think you're right. We can bring in the expected bankruptcy cost, at least the probability part. The cost of bankruptcy is still going to be a little dicey. But I think that we need to try if we're going to go with this approach. So I'm going to do it for the APV guys. I don't like this approach. But if you thrust it upon, say, this is the way you have to do it, let me do it right. So here's what I'm going to start with. I want to estimate a probability of bankruptcy and a cost of bankruptcy. I can either use CDS spreads, but those are available only for a very small subset of companies, right? I mean, it's not available for every company. But I can estimate a synthetic rating or an actual rating for your company. And you know how that helps me? Ed Altman every year does this study where he takes bonds and he classifies them based on the rating, and he looks at the probability of default. What percentage of bonds within each ratings class default in the next 10 years? So the way to read this table is, if you start off the 10 years with a AAA rating, only 0.07% of the bonds with a AAA rating end up defaulting by the end of the 10th year. And when they default, they don't have a AAA rating, obviously. But if you start off with a AAA rating, there's a very, very, very small chance that you will default. In contrast, you start with a BBB rating, which is investment grade. 7.5% of all BBB rated bonds default within the next 10 years. If you start off with a CCC rating, 59% of those bonds default within the next 10 years. Do you see what I'm going to do with this? I'm going to compute the synthetic rating for your company at every debt ratio. And if your rating is BBB, I'm going to give you a 7.5% probability of default. I know it's a shortcut, but it works at least as well as the next best choice. And the problem with using even CDS spreads, even if they're available for your companies, they'll be available only at the existing debt ratio. You're not going to get them at all those hypothetical debt ratios. So the probability of default, I'm going to estimate based on your synthetic rating. The cost of bankruptcy, the direct cost is fairly easy. It's about 5 to 10% of value. That's what goes to the lawyers and the court system. The indirect bankruptcy cost is the cost we talked about, grocery store versus aircraft. And it's completely subjective because we have very little evidence on the ground as to what that cost is. It can range anywhere from 5% to 30%. And you can make up a number, but make it up based on something substantial. Like if you're doing Boeing, you say, I'm going to go at the high end of the spectrum. If I'm doing Safewell, go with the low end of the spectrum. You see, that's not very satisfying. Well, if you don't like it, don't use the approach. That's basically it, right? I mean, it rests on this number. So I'm going to try this for Disney. I'm going to start off with the unlevered firm value. And remember I said the second way to do it is actually start with the market value and work backwards. The existing enterprise value, okay, existing market value for Disney as a company is $137.4 billion. That's just market value of equity plus debt. However, that value reflects the tax benefits that Disney is getting on the $15.96 billion, right? So I say, look, if you don't have the debt, then the tax benefits are going to go away. So I use the shortcut. I multiply the tax rate by the tax benefit, by the dollar debt, and there's my tax benefit being taken out. Is everybody clear on why I'm taking it out? If I took the debt out of the company, the tax benefits would not exist anymore. But the good side is if I take the debt out of the business, that bankruptcy costs I was worried about, which is not high because they're pretty highly rated, will also go away. And based on their rating, which is single A right now, that existing bankruptcy cost is 0.66%. The probability of bankruptcy is 0.66%. And I put Disney right in the middle. Between Safeway at 15 and Boeing at 40, Disney is around 25%. My guess is no family walks into Disneyland saying, it's a triple C rated theme park, I'm not going, kids. You know, Mickey doesn't look as good as a junk bond. Now, it's not something you think about, oh, you're not going to not go see Frozen because it's made by a triple C rated company. So I don't think it's going to be as substantial as a Boeing. So I put it right in the middle, 25%, and I added that back. So basically I'm taking out the tax benefits of debt because I no longer have debt, but I'm adding back the expected bankruptcy cost for the same reason. What I end up with, $132.3 billion, is my estimate of what Disney's value would be today if they had no debt. Is everybody comfortable with that? So this is a shortcut. I could do a full-fledged valuation, but I don't want to go there yet. So I'm taking the market value and extracting the effective debt. Now what's the next part? I want to look at what will happen if they go to 10%, 20%, 30%, 40% debt. And that's basically all I did, is I took each debt ratio, just like I did for the cost of capital. I computed the dollar debt exactly like I did for the cost of capital. I computed the tax rate exactly like I did for the cost of capital. Notice that the tax rate is actually dropping off after 70%. I computed the tax benefit, so this is where it gets different. In the cost of capital approach, I use these numbers to come up with the cost of capital at each step. Here I'm computing the tax benefits at each step, and notice that the tax benefits actually start to decrease at some point because by forcing my company to go beyond its capacity to pay, I'm actually reducing the present value of my tax benefits. The probability of default, my rating drops, and as my rating drops, notice what's happening to my probability of default. It's going from 0.07% to almost certain default at 90%. I multiply that by 25% of the value, I get my expected bankruptcy cost, and that climbs as my debt climbs. Last column, all I do is I take the unlevered firm value, add the tax benefit, subtract the expected bankruptcy cost, and I get my value as a firm at every debt ratio. What's my objective in corporate finance? Maximize the value of my firm, and that happens in this case very conveniently for me at 40%. You see why it's very convenient? Because the cost of capital approach gave the same one. You have no idea why that is. Maybe I tried a 20% bankruptcy cost and I got a different debt ratio and I tried 22 and 25. You never know these secrets, and I'm not going to give them away. But it's pure coincidence that I got exactly the same optimal. But it rests on that 25% cost. That's a big input. Yes? Because I have more interest expenses to cover, right? It's the same reason the cost of capital approach is my interest expense goes up, my coverage ratio decreases, my bond rating goes down. Anybody? So once you get out there, and you plan to get out there, right? You know, don't hang around here for the rest of your lives. Once you get out there, if you're in corporate finance or valuation, I guarantee you're going to run into somebody who says, I use the APV approach. Put them on the spot. Act like you know nothing about them. Say, tell me what you do. And they'll go through this elaborate detail about the unlevered firm value. And then they'll give you this detail about the tax benefits. And then they'll try to move on. Say, wait, I think you forgot something. When you borrow money, isn't there an expected bankruptcy cost? And so, well, we're ignoring that. So why are we looking at the optimal debt ratio then? Because we know it's always 99.99% debt. Because the way you do it, if all you do is add the tax benefits on, what's the point of the rest of the analysis? So if you're going to do this, at least do it right by bringing in the expected bankruptcy cost. And that requires work. And in my view, it actually requires more work and is more subject to manipulation than a cost of capital approach. That's why I stay with the cost of capital approach, is I think I do exactly the same thing, but at least I'm working with numbers that I'm more comfortable with, as opposed to hypothetical unlevered firm values and tax benefits from debt and bankruptcy costs. So that's the adjusted present value approach. Now I'm going to give away a secret. If you ask me how most companies come up with the debt ratios that they're at right now, the answer is very simple. They don't do an optimal cost of capital. They don't use the adjusted present value approach. You know what they do? They look at the industry they're in, define the way they define it. They look at what the debt ratios of other companies in the sector, and they try to stay as close as they can to that debt ratio. Incidentally, that's how they set dividends too. They look at what everybody else is doing, and if everybody else is paying dividends, they pay dividends too. Incidentally, that's also how they pick projects. If everybody else is acquiring companies, well, they have to acquire companies. So I call this Me Too corporate finance, because that's all you're doing. Me too, me too, me too. It's amazing that bright people, or maybe bright people, right, would do this, but actually it's not that difficult to understand. What's the advantage of staying close to industry averages?
You can avoid blame if something goes
If you screw up, you'll always have lots of company. And never underestimate the power of that. You're a telecom company, you borrow too much money, everybody else is borrowing too much money, you start getting into trouble. I say, why do you borrow so much money? I said, because everybody else was doing it. It's like a 6-year-old. Right? I mean, that's how, it's a 6-year-old's excuse. I remember when my youngest was 6, he came home from school one day, he'd done something incredibly stupid. And I asked him, why do you do that, Kieran? And he said, because everybody else was doing it, Dad. And then his mom jumped in with a classic mom response. You've heard it, right? If everybody else jumped off the bridge, would you jump off the bridge too? And he gave a classic 6-year-old response. Of course, Mom, do you want me to be strange? That's how companies pick debt ratios. And don't fight it. It's reality. I've actually done optimal capital structure analyses for a company. After an hour of going through the cost of capital, this is your optimal. The CFO will put up his hand and say, if we do this, will we look strange? You know what he's asking, right? If we do this, will our debt ratio look... And who can blame him? Because you have equally lazy equity research analysts on the other side doing exactly the same thing, right? What do? They say, you have too much debt. Why? Because your debt ratio is higher than everybody else's. This is like an elaborate dance where nobody knows what music is playing. And everybody's out of step. You don't want to be the only person in step in that room because people are going to step all over you in the process. So here's what I do. I concede the fact that even if I believe in the cost of capital approach, the person I'm talking to might be stuck on industry averages. So the onus is then on me to find out what that number is, and if my optimal is different from the number, I need to give the CFO some kind of comfort zone that will allow him to explain to the analyst why it's okay. And we know what you need to look at, right? So if for instance, I find that Disney's optimal is much higher than the industry average, what's the justification I would give to analysts as to why that's okay? What's my industry? It's the entertainment industry, right? Other than Time Warner, everybody else in the industry is a small, risky entertainment company like Lionsgate, which one good movie can make you a lot of money. So the argument there is you're safer than everybody else. You're bigger. That's why your optimal should be higher. If I'm Ryanair and my optimal debt ratio is lower than the other airlines, and the analyst says, why are you borrowing so much less? The answer is, hey, my tax rate is 12%. It doesn't pay for me to borrow money. So I'm saying even if you decide to go with the industry average, at least look at what makes your company different from the industry. So I'll give you the industry averages for each of my companies. Disney, Vale, Tata Motors, and Baidu. There's debt ratios measured using book value and market value. You say, why are we talking about book value? Because here again, you're playing on the CFO's turf, right? CFO might be an accountant. He says, I don't care about your market value numbers. Give me the book value numbers. So whether you like it or not, might as well bring it out and know what it is at least. I also look at net debt to cap. What's the difference? I net cash out. Why? Again, because some CFOs prefer to. So in a sense, you're playing on their turf and you got to play with their statistics. And I compare those numbers to what the industry averages look like. And here I got very lucky. And you're going to see in a minute why I got very lucky. When I did the optimal debt ratio for Disney, remember what I found? It was under-levered, right? Too little debt. You know how I'm going to buffer my recommendation now? I'm going to say, look, not only does my cost of capital show me that you have too little debt, but when I compare your debt ratios to the industry averages, you have far less debt on every single measure. You pick it. Book, market, gross, net. On every debt ratio, you have less debt. It makes it easier for me to sell my recommendation now because I'm saying, hey, push towards the average. Even if you don't believe in the cost of capital approach, you're moving towards the average. Very convenient. We'll talk about what happens when you get an inconvenient signal, but in this case, it's convenient. For Vale, if you remember, if I didn't normalize the income, they looked over-levered. They had too much debt. If you look at the numbers, it looks like they're slightly over-levered. Not as clean as Disney, but there is, again, the comparables kind of pushing in the same direction. Tata Motors, if you remember, was 29% debt. The optimal was 20, and we talked about the family group effect. If you compare them to the industry average, much higher debt ratio than the rest of the sector. Again, buffering my recommendation. And Baidu, which was at its optimal, you pretty much get the same conclusion, except on the book debt ratio, because their book equity is tiny. Okay? What I'm trying to say is, in this case, bringing in industry averages works in my favor, because if I want them to borrow money, I can say, look, you can borrow because your cost of capital goes down, but if you don't like that, borrow just to be like everybody else. I'll tell you when it gets difficult. If you have a company that is under-levered, the cost of capital approach, when you compare to the industry though, everybody else also refuses to borrow money. That's a tough sale. That's why technology companies take so long to borrow money. I mean, think about it. You look at Intel, you look at Apple, you look at Google. It took a lot of pushing, even though they had the capacity to borrow money, before they borrowed money. Because they compare themselves to other tech companies that were far smaller and riskier. But because they didn't borrow money, it was very difficult to be the first one out there. But once these companies go out there, it becomes easier for other companies in the space to borrow money, because now there's somebody out there that they can point to say, Apple did it, therefore I should be able to do it too. Okay. So that's what the industry averages do, is they bring in what's happening in the rest of the market. Sometimes it's going to help your case, sometimes it might make your case more difficult to make, but either way you need to be aware of this because somebody's going to bring it up. Now, if you look at the entertainment sector, there are like 100 and something companies. Some are small, some are large, some are risky, some are safe, some have high growth, some have low growth. And I have the debt ratios across, and what am I using? I'm using the average or the median, right? That's an incredible waste of data. You see why it's a waste of data? I take 121 debt ratios, I average, I take one number, and the rest gets thrown out. Wouldn't it be neat if I could use the rest of the data? So here's where having some statistics can help you. What am I trying to explain? Differences in debt ratios across companies. What am I worried about? Differences in tax rates, differences in risk, differences in growth, all those things. So here's what I did. I take the debt ratios across companies in my sector, but rather than just take the average, I look at how the debt ratio is different across different companies, given the tax rate, how variable. So basically, pick what you want to use as your proxies for risk and growth and tax rates, throw them in there. If you're lucky, and you might not be, you might find that companies with high tax rates have high debt ratios, and companies with low variance in earnings have higher debt ratios. In other words, you might see patterns across the sector. But here's the best part of it. Once you run a regression, you get an equation, right? Debt ratio is equal to this plus this plus this plus this. Plug in the numbers for your company into that regression, you will get a predicted debt ratio. This is like doing a Me Too with a little bit of sophistication, where you say, look, I know how the rest of the company is setting debt ratios. This is what my debt ratio should be. So I tried this for the automobile sector. I wanted to see whether Tata Motors was still over-levered. So I took the auto sector. I took the debt-to-cap ratios. There were 56 automobile companies in my sample. So these were large automobile companies across the world. I took the debt ratios for each company and ran a regression against the effective tax rate to capture the tax difference, the EBITDA to capture how much cash flow they had. Remember we said that that drives the optimal. And how much capex they need to reflect the fact that if you have a lot of capex, you probably have to factor that into whether you use debt or equity. So that's what I got as my regression equation. The R squared is 21%. And you look at it and say, that's horrible. Statistics class it would be. Because in statistics class, all you do is test things that nobody should be testing. Things like, what's the correlation between your weight and how much you eat? Okay, you eat a lot. You eat 5,000 calories a day, you're going to weigh a lot. Okay, 95% R squared. Thank you for letting me know. Or how about a regression of what's your GPA against how many beers you drink? You drink 50 beers, you're probably not getting out of bed, your GPA is in the toilet, confirmed at an R squared of 97%. For some reason, statistics professors seem to think that if they show you low R squareds, you won't buy statistics. It actually hurts them because you get out of the class, nothing in the real world worth testing has R squareds of 95% or 75%. So 21% is a little low. Am I disappointed? I'm not God. This is the way companies set debt ratios. If you're using other companies, I'm just holding a mirror up to you and saying, do you really want to base on other companies? Because there's nothing, no rhyme or reason for why you have high or low debt ratios here. So I'm going to take what I can get, 21% R squared, okay. I plugged in the numbers for Tata Motors into this debt ratio. Effective tax rate, their EBITDA, and their capex, and I came up with a predicted debt ratio of 18.5%. See, what does it even mean? Given how other automobile companies set debt ratios, and given Tata Motors' tax rate and cash flows and capex, I would expect Tata Motors to borrow 18.5%. Have a debt ratio of 18.5. Their actual debt ratio was 29.3%. More confirmation for what we already have seen, that the company has too much debt. So that's looking at the sector. I'm going to climb one more hill. One of the problems with sectors is that the sample size might be small. 56 is not bad, but some sectors you might have only 10 or 12. Would be neat if I could get a sample of 3,000 companies or 7,000 companies. Is it impossible? What if I took the entire market and I looked at the debt ratios for every company and ran a regression of debt ratios, this is across the entire US market, against the tax rate and the number of shares held by institutions and how variable they're operating. In other words, I'm running the regression now across the entire market. I'll give you the bad news. The R squared is 8%. There's a lot of stuff going on that I can't explain. But that's no surprise. This is the entire market. Some companies do crazy things. I can't bring them into the analysis. But an 8% R squared doesn't mean you can't use the regression. It just means that your predicted values are going to have a much wider range around them. So if you ask me what's a good R squared, it's not what a good R squared is. What kind of range are you going to get? Because the lower the R squared, the bigger the band around your prediction. So in this case, I'm going to have a pretty big band. I plugged in the numbers for Disney into that market regression. I came up with 18.86%. You see, what does that even mean? Given how every US company is setting debt ratios, and given Disney's numbers on those variables, its debt ratio should be about 19%. But here's the caveat. Given that R squared, if I gave you a range, it's going to be somewhere between 13, maybe plus or minus 6%. That's what the low R squared does. It creates a bigger range. Disney's actually at 15% debt. It's at the lower end of the range, so I can't reject the hypothesis that it's probably, it could be correctly levered. But I'm asking a different question than I asked in the sector regression. I'm saying, given your characteristics of the company and given how everybody else in the market is borrowing money, it's kind of an expanded Me Tooism. How much should I borrow? So you can use the cost of capital approach or APV approach. I call these intrinsic approaches because you're taking your company and coming up with the optimal. Or you can look at what everybody else is doing, either in the sector or the market, and come up with a predicted debt ratio. Let me ask you a question. When you get that optimal debt ratio, should you expect it to be pretty close, at least on average, to your cost of capital based optimal? In other words, if you run a regression and get predicted values. Or let me frame it differently. Can you think of a scenario where you look at how the market is setting debt ratios and you set a debt ratio that's just right, given how the market is setting debt ratios, but collectively all companies can end up with too much or too little debt?
The financial services industry in 2008
No, not even a sector. I'm talking about the entire market now, right? So sector, that can happen. Financial services, again, it's not too much debt. It's too little regulatory equity. It might sound like I'm saying the same thing. It's not a debt issue. It's a regulatory equity issue. But I don't know whether any of you remember or have read about the Korean market crisis in the mid-1990s. I remember I was in Seoul doing a valuation or a corporate finance session sometime in the early 90s, and I had 4 Korean companies, and I did the cost to capital approach for all 4 of them, and I found them all to be significantly over-levered, like Samsung, Hyundai, all the big names. So I presented that, and they all looked like they had too much debt. And in fact, the CFOs of all 4 companies were in the audience. So I threw it out, what's going on here? What do you think was going on in Korea in the 1990s that allowed these chaebols, which were basically these industry groups, to borrow too much money? Why were banks lending them so much? Because the Korean government had an implicit guarantee that said, if you lend money to a chaebol, we'll back it up. So if you think in terms of the trade-off, right, tax benefits versus bankruptcy costs, you see what they've done? The government has said, we'll bear some of the bankruptcy costs or a big chunk, which means you're going to go out and borrow like... So if you did a market regression for Korea in the mid-90s, and you look at Samsung, they look like they were fairly... Given how other Korean companies were borrowing, they all looked okay. But given their cash flows, they were all borrowing money, borrowing too much money. And of course, what happened was the Korean government gave this guarantee, expecting one of the chaebols to get into trouble. We can back it up. But when they all got into trouble at the same time, the Korean government said, we don't have enough money to back you guys all up. And that caused this meltdown in the market in 96 and 97. So you can sometimes get an entire market borrowing too much money because somebody is putting their fingers on the scale. Usually the government saying, tilting the scale. But you can't keep your fingers on the scale collectively for a long period. So I run these regressions simply to get a sense of, are we collectively going crazy? Are we borrowing too much or too little money? Because when you get a mismatch from the market regressions and the optimals, that's what you're finding out. So let me pull all the numbers that I have for all of my companies. So we've gone through all these different approaches. Let's see where we are. Start at the top. There's my actual debt ratio for Disney, about 12%. Vale 35, Tata Motors 29, Baidu 5.23%. I didn't go through the operating income approach, but what you do there is you check to see companies actually constrain their operating income to be some multiple of interest expenses. It's a very simplistic approach. I tried it just for Disney, 35% optimal. We use the cost of capital approach. 40% for Disney, 30% if I use the actual numbers for Vale, 50% if I normalize it, 20% for Tata Motors, 10% for Baidu. If I look across Disney, every single predicted number, whether I use cost of capital approach, the APV approach, the sector average, the market average, in every dimension, Disney looks like it has too little debt. Okay? When I look at Vale, it's a little over-levered on almost every approach if I use the actual numbers. But if I use normalized numbers, it's much more defensive. Tata Motors looks over-levered in every single measure that I have for optimal. And Baidu looks about where it should be, almost every approach. It's slightly under-levered with some, slightly over-levered with others. What I'm saying is most approaches, if you do them right, will lead to convergence on what a company should be doing. So why force yourself into one approach? I use only the cost of capital. Do two. May try 3 approaches. There's nothing that is difficult about any of these approaches, and you're trying to make sure that what you're suggesting to the company is something that they can sustain. So here's where we are. The optimal mix of debt and equity is the one that maximizes the value of the firm, either by minimizing the cost of capital or by actually doing the valuation. So let's say you get to this point on your project. You will, right? So I'll drag you there. Where you come up with the optimal for your company, just like I have done for my companies, and you have the actual. One of 3 things is going to be true at that point. Either your company has exactly the right amount of debt. Its actual is equal to the optimal, in which case, do nothing. It's fine. That's an option. So you say, my company is at its optimal. And that includes companies where the optimal is 20 and you're at 22, 23, or within shouting distance. Yeah, I'm at the optimal. But let's look at the other 2 scenarios. You could either have too little debt, your actual is much lower than the optimal, or too much debt. We already said which problem you'd rather have, but you don't get to pick the problem. You pick the company, but now the problem comes with the company. So you could have too little or too much debt. So now you're faced with what to do next. And there are two things you have to decide. One is, do I have to move quickly to that optimal? Is there any urgency involved? And we'll talk about what drives that. And the other is, how do I get to the optimal? And there are two ways you can get to the optimal. One is by recapitalizing, which means you just borrow money and buy back stock or issue equity and retire debt. In other words, you're playing with the liability side. The other is a more long-term way of increasing debt ratio, which is over time as you take projects, you use a disproportionate amount of debt. So over 3 or 4 or 5 years, you can increase your debt ratio or increase equity. So how quickly should we do it and how should we do it? So here's what I'm going to give you. It's a framework I use once I'm done with the optimal. So don't jump and get to this before you're ready. You've got your optimal in front of you. Ask yourself, is my company under or over leveraged? Let's take the more pleasant side of the problem. Your company has too little debt. The first question you need to ask yourself is my company potentially the target of a hostile takeover because it has too little debt? So let me ask you a question. Why would having too little debt make you potentially the target of a hostile takeover? What is it? Think like an acquirer. I'm a company with too little debt. Why does having too little debt make me a more attractive candidate for you?
You can do an LBO. You have the cash flows there.
In fact, let's not even go LBO. You can borrow money using my assets to buy me out. I'll give you an analogy. The analogy doesn't quite fly, thank God for it. Let's assume you buy a house in the New York area. And even with housing prices down, it'll cost you probably $1 million plus. And unless you're a drug dealer, you're not going to be able to pay for the entire house with cash. So let's say you borrow money to buy the house. And you're very frugal. Over the next 5 years, you save your lunch money. You eat big lunches. And you pay off the entire loan. You now own the only all-equity financed house in your entire neighborhood. You decide to have a mortgage burning party. You heard of these in the old days? People used to live in the same house for 30 years. Can you believe that? And the 30-year mortgage, they make the final payment, and they have a mortgage burning party where they'd invite all the neighbors over. They'd have orange juice and coffee cake. And they'd physically burn the mortgage. Once in a while, they'd burn the house down with it, too. That's kind of tragic when it happens. It's a tragic comedy, if you need be. So you decide to have a mortgage burning party. You're an old-fashioned person. You call all your neighbors over and say, we're going to have a party. It's a mortgage burning party. You invite the local firemen, too, just in case. So while you're sitting around the table, your neighbor Bob, who's never liked you, he doesn't like the shrubs you picked, he doesn't like the way you cut the lawn, he doesn't like the way you rake the leaves, basically he just doesn't like you. But he's come because it's free coffee, cake, and juice. So, and while he's sitting there eating your coffee, cake, and drinking your juice, he's plotting his revenge. So right after the party, here's what he does. He goes to the friendly neighborhood bank. And he says, there's all equity finance, $1 million house in my neighborhood. Will you lend me $800,000 against the house? This is where the analogy breaks down, right? You go into a bank and you try to borrow money in your neighbor's house. It's usually not an acceptable idea. But this is your friendly neighborhood banker. He says, no problem, Bob, here's $800,000. So Bob has now borrowed $800,000 using your house as collateral. He now does a hostile acquisition of your house. Don't ask me how this works. He approaches your kids and says, hey kids, have you been really happy with these parents you've had? Would you like the basement to be yours? We make it a romp room. You can do whatever you want. They sell their 25% stake. Next thing you know, Bob has 50.1% of your house. He throws you out. Thank God this can't happen with a house. But let's change the facts a little bit. Let's assume instead of an all-equity financed house, you have an all-equity financed public company. It's a $1 billion company that can afford to borrow $600 million, but it borrows nothing. Why? Because the CEO is a really conservative fellow. He hates to borrow money. I see the house. I see the company. I go to the friendly neighborhood bank and ask the same question. Can I borrow $600 million against that company? The bank says, no, that's not your company until 1981. That's the end of the game. We talked about what happened in 81. What did Drexel Burnham and Mike Milken create? A junk bond market. So here's what I do. I issue $600 million. The essence of a junk bond is it is issued with no backing. So you say, why would I buy that bond? I give you a really high interest rate. And you look at my track record, and historically I've paid people off because I do the acquisition. So I raise $600 million junk bonds. I use that 600 million that I borrowed using your company as implicit collateral to acquire your company. And here's where it gets really good for me. You're a conservative CEO, right? So in addition to not borrowing money, what have you very conveniently accumulated for me in the company? You've accumulated 300 million cash. So right after I take over your company, using your assets to borrow 600 million, I take $300 million of your cash to pay off the debt I borrowed using your... You can't get any sweeter than this. You might as well have paved the road for me and say, come on in. So the first question you have to ask yourself is, am I the potential target of a hostile acquisition? So think about your companies. Some of your companies are going to be underlevered. You'll have to ask this question. And don't look for news stories. By the time it happens, it's too late. Here are 3 things you should look at. First, look at the size of your company in terms of market value. If I told you that Google was underlevered, and it is, are you worried about it being the target of a hostile acquisition? What are the 2 things that will kind of conspire against you if you try to do a hostile acquisition of Google? One is a lot of money, $300 billion. The other is you got to get to 51% of the voting shares, and that's going to be really, really, really difficult at Google, not just because Sergey Brin and Larry Page own a large percent, but they also control the voting rights. So the first 2 things you're going to look at are the size of the company and how the voting structure in the company is, because the insiders control 25, 30, 35%. Getting to 51% is going to be really difficult. There's a third thing you should focus on. Every hostile acquisition is a fight between 2 sides. On one side is the hostile acquirer, and the other side is the incumbent manager. And for once in your life, the stockholders are the center of attention. So you be the stockholders in the company. We're going to play a little game. The hostile acquirer comes to you and says, don't trust those manager guys. They don't care about you. And the manager guy says, don't sell to the hostile acquirer. They're going to ruin the company. And you get to decide who to trust. Let me tip the scales a little bit. Let's assume that over the last 5 years, your stock is down 80%. So who are you going to trust? The hostile acquirer who says, don't trust the managers, and the manager said, trust us, we know what we're doing. So the third thing you should look at is how well or badly your stock has done after adjusting for the market and after adjusting for risk. Does that sound familiar? It should. Because early on we did come up with a measure of that, right? We called it Jensen's alpha. So here's your trifecta if you're looking at an underlevered company that you have to worry about. It's a small to mid-sized company with very little insider holdings and a big negative Jensen's alpha. Time is not your ally. You got to do something quickly. This is where you have to do, when you heard about leverage recaps, this is where you're going to be forced into a leverage recap, because if you don't do it, it's going to get done to you. In fact, between 87 and 92, there were 101 leverage recaps. 98 of them were triggered by a hostile acquisition bid. It's your defensive mechanism. So if you are under threat of takeover, you got to do something quickly. If you're not, then ask a follow-up question. Do I have good projects? Don't ask the managers, do you have good projects? Because you always get the same answer. Of course. Trust but verify again, right? You'd like to see whether their history suggests that they've taken good projects. So you'd like a number that says, hey, this company has historically taken good projects. And here again, remember how we computed the return on capital for the entire company and compared to the cost of capital? For Disney, for instance, it earned more than 4% more than its cost of capital. That EVA, the spread. If you have earned more than your cost of capital, I'm going to give you the leeway to go out and continue to use your capital to grow. And so if you have good projects and you have debt capacity, it's a marriage made in heaven. Borrowing money to take those good projects creates a double whammy. The first whammy is moving to the optimal lowers your cost of capital. You use that debt to take good projects. What's the second increment in value you get? What's the definition of a good project? It has a net present value greater than 0. And what happens when you take a project with a net present value greater than 0? It increases your value as a company. So if you have debt capacity and good projects, use the debt capacity to take good projects. If you don't, and time is your ally, think of a way to return more cash to your stockholders. Pay more dividends, buy back stock. Over time, your debt ratio will go up. So that's if you're under-levered. If you're over-levered, I'm going to ask the same question. How much time do I have? And here there's a morbid ring to the question. Because if you have too much debt, what am I worried about? that you're going to go bankrupt. So are you under threat of bankruptcy? Here again, let's look at the things that you might focus on. If they have a rating, you're going to see, what's your rating? It's triple C. Don't waste your time saying, are you under threat of bankruptcy? You are. Do something quickly, right? But even if there's no rating, you can compute interest coverage ratios and synthetic ratings, but you don't even need a ratio. I'll tell you something. If you're with a company which is in financial distress, you will know. You know how you'll know? You land at an airport 15 miles away and they'll ask you to walk. So cabs, we can't afford that. And by the way, bring your own toilet paper while you're coming. There's nothing here. I mean, walking into companies that are under threat of bankruptcy is like walking into funeral homes. Just the atmosphere will tell you the company is in trouble. And if you're in trouble, if you're under threat of bankruptcy, you have to bring your debt ratio down quickly. And it's one of the most difficult things to do. Take a while. Give me some suggestions on how I can bring my debt ratio down quickly. I have too much debt. What are some of the suggestions you would have for me for bringing my debt ratio down? I'm sorry? Issue new equity. Right? So let's say I get ready to do that. What's the roadblock I'm going to run into? What are the news stories everybody's been reading about me for the last 2 years? Trouble and trouble and trouble. I'm trying to issue shares. It's going to be really tough for people to invest in those shares. So I'd like to issue equity if I can, but what else can I do? Sell assets. So let's try that. So I announced that I'm going to have an asset auction. Everybody knows I'm desperate for cash, right? If my assets are unique, I'm trying to sell casinos, there are only 3 potential buyers in the whole world. And they all know I'm in trouble. So I come there with $1 billion casino and the guy offers me $10 million. Steve went across the table, $10 million. It's $1 billion casino. $10 million, take it or leave it. Maybe 15. By the time you walk out of the room, you get $20 million, you think you're a winner. Okay? Selling assets becomes difficult because everybody knows your bargaining position is short to hell. So you know the only thing you have going for you is that you might go bankrupt. I know this sounds incredibly unethical, but use it in your favor. What happens after you go bankrupt? You end up in the court system, threaten to throw yourself there. And say, you'll never see your money. That 10% interest rate, I'd like a 1% interest rate. The 1-year bond, let's make it a 100-year bond. You say, why would you agree to that? If you don't agree, I'll throw myself at the mercy of the court and the lawyers are going to take everything. It's amazing how much people extract there. And there are people who are masters at this. One of these has his own TV show. He calls himself a great businessman. Donald Trump, right? The guy's a serial defaulter. You know how often he's defaulted in his life? Almost every time he borrows money, he defaults. He's a master. He walks into a bank and says, $125 million I owe you. I don't think I'll pay you. The banker says, what do you mean you don't think you'll pay? I don't think I'll pay you. And by the time Donald Trump walks out of the bank, the banker is happy. He settled for $10 million. Look, I won. I got $10 million of that $125 million loan. I don't blame Donald Trump for doing what he does. He's playing the game. My question is, why do you guys keep lending to him? That's really the question you need to ask. Is if you choose to lend to him, you deserve to have this game played out on you. So if you're under threat of bankruptcy, do the best you can. And there have been some really, and I'll end with this, some really novel and interesting ways in which borrowers have dealt with this. In the late 1800s, Latin American countries were the growth horizon for a lot of European banks. They would lend to these countries, and they'd go bankrupt. So I guess this is a habit that's deeply ingrained in Latin America. So I don't know which Latin American country it was that had gone bankrupt. So this French bank was owed money. So the Latin American country sends a message back to the French bank saying, you know that loan you gave us, we can't pay you back in cash. But we can pay you back in guano. Not guano, it's bird droppings. So we have a lot of bird droppings here. Initially the bank said, we don't get paid in bird droppings. So they said, would you like the bird droppings or would you like nothing? The bank said, send the bird droppings over. Big ships of bird droppings go from Latin. It's great fertilizer, I guess. So try that out with if you're in trouble, offer to pay with bird droppings. A lot of bird droppings on our okay. So we'll continue with this on Monday.
Just a quick question about your model. The lease payments, is the 6 year and beyond, is that the present value of all future lease payments? The 6th year and beyond lease payments, is that, do we need to fill out the present value of all future lease payments, or like just the in that?
I'm not sure what the question is. There is a lump sum in year 6 of all
Yeah.
these payments beyond. So what
So that's like the present value of all the future.
that's normal.
That's the yearly
That's a
perpetual.
normal amount. There's no present value at all in that table. It's
Because
all normal.
in the 2 models that you sent, the 6th year one was like 5 times the first 4 year.
Basically, whatever the average lease payment is over the first 5 years, I look at that average and try to make the 6 years an annuity based on the average. So it's not always going to be 5 years. It could be 3, it could be 15, depending on what the average is.
It was like 5 times bigger.
No, the lump sum will always be a big number, but it's not all due in year 6. So I'm trying to make a judgment on what the annuity is beyond year 6
Oh, okay.
that leads to that lump sum, and I'm trying to make that judgment by looking at what the average is.
Okay, okay, got it now. Annuity for the.
Yes.
I don't know what, I have my iterations turned on, but I don't know.
It's too late. You have to go back to basically open a fresh version of the spreadsheet. Go to the input page, copy and paste it.
All this stuff. Oh, that's so weird. Okay.
So
Do you
basically,
know why
it's
that happens?
because you have the iteration thing. If you entered one typo, let's say you entered 5.35 and then you fix it. Once you've entered a typo, the spreadsheet goes off in what I call spreadsheet help.
Okay. That's where my spreadsheet is. All right.
It won't come back because basically it's twirled off. The iteration process is taken it so far off
Got
the
it.
track.
Yeah,
that
because I was
fixing it
trying to
comes
like
back.
go
It's
through and
easier
re-enter.
to just download a fresh version of the spreadsheet.
Turn on the iterations
Run the
and then put
iterations
in the
first and
data.
paste. Yeah.
Okay. Thank you.
So I'm doing Diageo, which has listings on the London stock and New York. How should I kind of be handling that?
Where does it even enter the drop? The only place is probably the regression.
Yeah.
Because the beta, you're using the
Yeah.
bottom up beta, it doesn't
Yeah.
matter, right?
Okay.
So basically the only place it makes a difference is in the regression.
Yeah.
I would say with the list, which is new case.
Okay. Perfect.
Two quick questions. One, this is the set if you are AAA or you entered with this. What happens if you drop? Because I'm doing Netflix.
No, this is at a point in time. So
Okay.
basically you have to look at the existing rating.
Okay.
And basically that will give you the probability of
What do you say, like
default.
just
Got it.
Netflix is what
where do you
They were double B minus, and now they just dropped to something
So
else.
basically there's
Yeah.
a high probability of default, mostly because of their network commitments.
Got it. You're referring to like dog ear things.
yeah, but
Okay.
like
And then
okay. And
where A, B, C, D? Where's the thumbs come?
Those when you run the regressions. Right now I'm just setting it in the abstract and
Thank
you actually
you.
have the data.
Okay.
The A, B, and C, D will come as output from the regression. So
Okay.
you run mini tab, that's what shows up as coefficients.
I was afraid of that.
Yeah.
Okay. Thank you.
You're welcome.
Actually, one last question. I emailed the TAs, but I figured I might as well ask you. Where can I find the pre-tax cost of debt? I've looked on,
You got a rating already, right? Double B.
yeah.
The table actually has a default.
And I can just
written
use
double.
that?
That's it, you're done.
Okay.
Just add it to your risk-free rate. you're done.
Okay, because I'm like looking online, I was like,
If you don't have bonds, you can't find it online.
okay, thank you. I'm just like going crazy already.